My buddy Kevin just put $50,000 down on his first rental property. He thinks he just made the smartest financial decision of his life. The same week, I dropped the exact same 50 grand into a boring index fund. Kevin laughed at me, told me index funds are for people who don't have the guts to be real investors. 20 years from now, one of us is going to be exactly $520,000 ahead of the other. And the answer is so counterintuitive that even I didn't believe the math the first time I ran it. And I've owned 9 rental properties for the last decade. So before Kevin spikes the football at next year's Christmas party, let's run the actual numbers. Every cost, every tax, every broken water heater, every drug dealer tier surprise. 20 real years. Kevin and I made a bet. Same 50 grand, same paycheck, same age, same city. 20 years. Whoever ends up ahead buys dinner, or, more realistically, picks up the entire tab for the rest of our lives. Kevin used his 50 grand as a 20% down payment on a $250,000 rental. 3-bedroom, decent neighborhood, 30-year mortgage at 7%. He found a tenant for $1,800 a month. Mortgage payment $1,330. On the napkin, $470 a month in pure profit. Kevin called it, and I quote, free money the bank pays you to own a house. Kevin spent the entire barbecue laughing at me. Said index funds are for people who, quote, don't have the guts to own a real asset. Said I was going to retire as a poor coward who let the bank get rich off his money. I dropped my 50 grand into a total stock market index fund. Set up a $300 auto transfer. Closed the laptop. Said nothing. Because I already knew something Kevin didn't, and it had nothing to do with guts. 3 months later, Kevin called me at 11 p.m. He wasn't laughing anymore. $470 a month. This number lived on a napkin in Kevin's apartment. This number was in his head when he went to sleep. This number is fiction. I know because I wrote the same number on the same napkin 9 times. Fold 1, property taxes. Here's the part that wrecked me on my first 3 properties. Property taxes haven't just been high, they've been climbing. In a lot of markets, property taxes have jumped 20, 30, even 40% over the last 3 years. Kevin budgeted $3,000 a year. By year 5, he's writing checks for $4,200. The county doesn't care that Kevin ran the numbers in 2024. I learned that one the expensive way. Fold 2, insurance, $1,500 a year. Also climbing every renewal. Also non-negotiable. Also didn't make it onto Kevin's napkin, or mine, the first time. Fold 3, vacancy. The average rental sits empty about 1 month a year. That's a full mortgage payment with 0 income coming in. Kevin told me his property was going to be occupied 365 days a year. I asked him if he'd ever met another human being. Fold 4, maintenance. 1 to 2% of property value per year. Some years it's a $40 washer. Other years it's a $7,000 HVAC replacement in August when your tenant is threatening to leave because it's 104 degrees and the thermostat says LOL. I have lived that exact August. Twice. Fold 5, capital expenditures. Roofs die in 20 to 25 years. Furnaces in 15 to 20. Water heaters in 10 to 12. These are guaranteed expenses that arrive in chunks of $5,000 to $15,000, and they don't text you ahead. If you're not setting aside money every month for them, you're not running a business. You're running a slow-motion financial accident, which is exactly what I was running on 3 properties before I figured this out. I sat down with Kevin and we ran his actual 3-year cash flow. After every cost, the napkin number, the one he'd been bragging about, collapsed to somewhere between $2,000 and $4,000 total, not $17,000. And that didn't include a single hour of his time. Or, and this is where it gets fun, what happened to me in month 8 of my second property. Let me tell you about the worst tenant I ever had. This is a true story. This is the story I told Kevin when he asked me what unexpected costs really looks like. $500,000 house. The kind of neighborhood where I assumed tenants were software engineers and pediatricians. I screened the guy myself. Credit check passed. Employment verification passed. References glowing. The full BiggerPockets due diligence playbook. I was top of the class. I felt smart. 6 months in, I got a call. Not from the tenant, from the police. My tenant, the software engineer on paper, was running a drug operation out of my rental. He went to jail, which, as it turns out, is somehow more paperwork than evicting from a couch, because now I'm doing eviction proceedings via a correctional facility. $5,000 in repairs alone. Add the lost rent during eviction, the legal fees, and replacing every lock in the building. That single tenant erased my entire annual cash flow on that property. One guy, 1 year, gone. And here's the part that still keeps me up. The S&P 500 didn't get arrested that year. The S&P 500 didn't sell drugs out of my living room. The S&P 500 just sat there, doing index fund things, and went up 24%. Kevin laughed when I told him this story. Then he stopped laughing. He realized he had no idea who was about to move into his rental. Now, I want to be honest, I'm not the guy unclogging toilets at midnight. It took me 3 properties to figure out I'm not built for that. I have property managers. pictures. Smart move on paper. They handle the showings, the repairs, the tenant calls. In exchange, they take 8 to 10% of every rent check, every single month, forever. And paying them doesn't actually buy me freedom. It bought me a different job. Now I'm reviewing invoices to make sure I'm not getting charged $800 for a $40 part. I'm checking the listing photos because last time the manager posted 3 blurry pictures and the unit sat empty for 6 weeks. I'm calling to ask why my premium tenant screening missed the part where the guy was running a drug operation. I'm not the maintenance guy. I'm the maintenance guy's boss. And the boss still has a job. My index fund, it doesn't have a boss. It doesn't have employees. It doesn't have a premium screening process that somehow lets felons in. It just goes up. You know what else my index fund doesn't do? It doesn't call me. Mark Zuckerberg has never once dialed me up to ask my opinion on Meta's customer acquisition strategy. Tim Cook has never texted me at 11 p.m. about a supply chain issue in Vietnam. I own a piece of every major company in America, and not one of those CEOs has ever needed my input. That's the entire pitch. I give the market my money, and the market does not give me a job in return. For 10 years, the loudest voice on YouTube telling me to buy rental property was Graham Stephan. 5 million subscribers, 120 million in residential sales since he was 18. Built his entire empire on 3 words: buy and hold. Posted hundreds of videos telling me exactly how to do it. I watched them. I bought into the buy and hold gospel. He's part of the reason I have 9 of these things. 2 weeks ago, he posted this, quote, "After years of building, managing, and advocating for the buy and hold lifestyle, I've reached a final conclusion. I am officially selling the rest of my real estate over the next few months and walking away." The buy and hold guy, selling everything, walking away. He said his properties were returning 4 to 5% after expenses, which, fun fact, is roughly what a risk-free treasury bond pays right now while you sleep. He literally said in his own newsletter, quote, "I'm much happier just throwing it all in an index fund and letting it do the heavy lifting for me. When the king of buy and hold quits buy and hold, and I'm sitting here with 9 of them, you start running the math differently. That's not a coincidence. That's the math winning the argument out loud. But I want to be fair to real estate. Let me give it the strongest defense I can, because I bought into all 4 of these reasons myself. Real estate has 4 legitimate advantages, and I bought 9 houses chasing them. I want to be honest about all of them, because if I don't lay them out, the comments are going to do it for me. 1. Leverage. Kevin used 50 grand to control a $250,000 asset. When that property appreciates, he gets appreciation on the full 250. I did the same thing 9 times. It worked, and I'm not going to pretend it didn't. 2. Tax advantages. Depreciation, mortgage interest deductions, 1031 exchanges. If you have profit to shelter, real estate is genuinely tax efficient. I'm using these right now to slow down my exit, and I'll explain how at the end of this video. 3. Inflation hedge. Rent goes up. Your fixed mortgage payment doesn't. That part is real. 4. Forced savings. Every mortgage payment is partly principal. If you have no discipline, real estate forces you to build equity whether you want to or not. All 4 are real. All 4 are also weaker than they sound. But there's one I want to spend a second on: leverage, because this is the argument every real estate bro pulls out at Thanksgiving. But Max, what about appreciation? My house is up 200 grand. I used to be that bro. So let me show you what I missed. From 2020 to 2025, U.S. home prices went up almost 45%. That's the biggest 5-year run in modern history. It was driven by 3% mortgage rates, a pandemic housing shortage, and remote work redrawing the entire map. Every one of those forces is now gone. The historical average for home appreciation is 3 to 4% a year, not 9, not 12. 3 to 4. If you're buying a rental in 2026 and assuming the next 5 years look like the last 5, you're not investing. You're betting on lightning striking the same spot twice. It almost never does. And that's where the math finally caught up to me. 20 years, same 50 grand each, same 300 a month in additional savings. Kevin into the rental, me into the total stock market. Real numbers, everything included. And critically, I'm assuming home appreciation goes back to its historical 3 to 4% because it has to. Years 1 through 3. I watched Kevin's cash flow drain through every cost I'd warned him about. Taxes, insurance, vacancy, a broken garbage disposal that he texted me a picture of at midnight. $2,000 to $4,000 total. 3 years of being a landlord. His equity grew to roughly $55,000 to $65,000. My portfolio at 14% average return, about $92,000. I was already ahead. He'd spent 40 plus hours managing the property. I'd spent 0. Years 4 through 7. Kevin was on his 3rd tenant. He'd replaced the roof, $8,500. There was a plumbing thing. There's always a plumbing thing. His property tax bill kept going up. His real cash-on-cash return had settled around 3 to 5%, a tenth of what the napkin promised. My portfolio, roughly $185,000 to $210,000. The compounding started doing things math teachers warn you about. Year 10. I checked Kevin's equity, about $170,000 to $185,000. I checked my brokerage app for the first time in months, $325,000 to $365,000, almost double his wealth. He'd spent over 500 hours of his life getting there. I'd spent the equivalent of one afternoon 10 years ago setting up an auto transfer. Year 2020, Kevin's mortgage is paid off. His property is worth roughly $450 to $500 grand, assuming normal appreciation, not another freak run like 2020 to 2025. His total accumulated cash flow over 20 years, after every repair, every vacant month, every drug dealer tier surprise, lands around $40,000 to $80,000 on top of the equity. Call his total position $180,000. My index fund portfolio at 14% average return, $700,000. Same 50 grand, same 300 a month, same 20 years. That's the gap. $520,000. $500,000 between the guy who bought a house and the guy who clicked auto invest and forgot about it. And I didn't have to evict anyone from a jail cell to get there. Now, does that mean nobody should ever buy a rental? No. There are exactly 3 people who should still buy real estate in 2026. Number 1, house hackers. I have a friend who bought a duplex, lives in one unit, and rents the other. He's not really a landlord. His neighbor is paying his mortgage. The math here is genuinely incredible, and it's the one real estate strategy I would still tell my own brother to do. If this is you, buy. Number 2, people in markets with 1% rent ratios or better. That means a $200,000 house that rents for $2,000 a month. These markets exist. They're mostly in the Midwest and the South. They're getting harder to find every year, and they require you to actually live near them or hire a manager who'll take 10% off the top. If your local market clears 1%, the math can still work. None of mine did. That's part of how I ended up here. Number 3, people who genuinely want to run a small business, not a passive income side hustle, a real business. You like screening tenants. You like being a project manager. You like negotiating with contractors. If that's actually you, real estate is a legitimate career, and you should not be watching a YouTube video to figure that out. Everyone else watching this, that's about 90% of you, and that's where I should have been a decade ago. The answer is the index fund. Here's the question I want you to actually answer. Not real estate or stocks. That's the wrong question. The right question is, do you want to look wealthy or do you want to be wealthy? Real estate looks like wealth. People can see it. They drive past it. They congratulate you at the barbecue. Index funds are invisible. Nobody throws you a parade for hitting 400 grand in VTI. And that's exactly why most people pick the wrong one. They're optimizing for the photograph, not the bank account. I did, for 9 houses and a decade. Remember the Christmas party I mentioned at the start? The one where Kevin was supposed to spike the football? Kevin sold the rental in year 4. The water heater broke. Then the tenant stopped paying. Then the property tax bill arrived 28% higher than the year before. He ran the numbers, actually ran them this time, and listed the property the next morning. He took the equity, dumped it into a 3-fund portfolio, and went to bed. He hasn't called me at 11 p.m. since. I still own all 9. And before anyone in the comments accuses me of being a hypocrite, let me explain why. If I sold all 9 properties tomorrow, the IRS would hand me a capital gains tax bill north of 400 grand. That's not a typo. Selling a portfolio I built over a decade in one shot would erase years of progress in a single tax return. So I'm not selling them all at once. Nobody who actually understands the tax code would. Here's what I'm actually doing. 1 property a year, maybe 2 in a good year. Spread the capital gains across multiple tax cycles. Use 1,031 exchanges where it makes sense. And every dollar of cash flow those 9 properties throw off in the meantime goes straight into the index fund that just embarrassed them. Because the math finally beat my ego. $520,000 over 20 years isn't a tie. It isn't, depends on your situation. It isn't, well, real estate has its place. It's a verdict, and the verdict is in. Stocks won. Not because real estate is bad, but because almost nobody who buys a rental is actually getting paid for the work, the risk, and the hours they're putting in. They're getting paid like a landlord and working like a maintenance crew. My index fund doesn't ask me to do either. So if you're Kevin from the start of this video, the version of him who hadn't run the numbers yet, close this tab, open your brokerage app, and set up the auto transfer. The same one I set up. The same one Graham Stephan now wishes he doubled down on a decade ago. If this video saved you from making a 400 grand mistake, hit subscribe. That's the only thanks I need. And tell Kevin I said hi. He's still buying dinner for the rest of his life.